Let's move on though and talk some more market metrics that we're watching today. Alastair Schultz joins us from acysecurities in Sydney. Alastair, always a pleasure to have you on the show. Thanks for joining us here on AusBiz. I want to kick it off, I guess, with what we're watching on markets more broadly and the gains we're seeing. We've been talking tech a lot today, but why not? We're seeing tech continuing to rally. Every time someone calls the top, it seems to move even higher.
It does seem to be that way, doesn't it? Especially for the NASDAQ and the S&P 500. To me, looking at what's going on within the tech sector, we've really got, Apple and Amazon that are really driving some of the rallies that we're seeing in the NASDAQ at the moment. The first part of that is really that they've got 25% weighting nearly or close to it at the least of the NASDAQ. So just the small gains they've seen from Prime Day ahead of schedule. And of course, the new iPhone release coming out has got people sort of starting to trade that way as well. A couple of other things, though, that I've noticed along the way. The first one is that phenomenon we've seen all throughout the year being based on what's happening with options markets and how some of the retail traders are going on. And that's because we're seeing the volatility rise as well as stock surging, which is something we've kind of started to look down as a part of what's happened in the options markets. It's been that signal for us for most of this year. And it's not the first time it's happened. We saw it in August and September. We saw it back in sort of March. And it's continuing again now. So it does seem to be that we're sort of getting this situation where the tail is wagging the dog as opposed to the dog wagging the tail. And that might mean that we look towards options markets a little bit more readily before we do start looking at equity markets, which we might see the rises happening there. Obviously, that's not going to happen every single time, but on days like yesterday, where it was a bank holiday, we had low volume, I would be expecting to see that happen more than once again. Of course, you could simply sort of just say that it was the big sort of tech giants that really did the push, and they've been underperforming as of recent in comparison to this year, but there's a combination of effects that have actually helped drive it up at all.
When you look at what's coming up, because of course equity earnings in the US, that's the big one this week. We've got a lot of banks reporting. What are you watching there, I guess, to drive the story further in markets more broadly?
Yeah. Okay. So for me personally, I mean, I'm keeping a close eye on banks in general. Banking stocks in Australia a lot, and of course, US ones do have a level of impact. I'm really focusing a little bit harder on Citigroup than I'm going to be on JP Morgan or Bank of America or any of the other sort of US banks, more so to do with their ties that are outside of the country. Of course, the earnings results are going to be coming from within the US itself. So I am going to be keeping a close eye on all of them, but more readily available on that Citigroup one. In terms of the markets more broadly, I think this change of stimulus plan that we've seen in the last sort of 24 hours, 48 hours, with there not going to be any further updates for us to really pay attention to, that makes it a little bit more to me, it sort of says that investors have sort of gone from that switch again. They've decided that, okay, well, perhaps we should be prepared for the idea that we're going to see a road bump in the recovery efforts for the US. And I think traders are starting to, and investors are starting to look more towards that growth trade that they were taking at the beginning of the year. They're looking back at those tech giants, the tech stocks, because it's something that worked before, and they are anticipating it working again throughout this area where we're not sure whether we're going to get more stimulus, and we're certainly not sure if it's going to be suitable for us or not. Of course, that could all end very, very quickly if we do manage to get an agreement through. But at this stage, it's looking like, at least for this week, we're not going to be getting much more on that talk.
Yeah, it's interesting. How much do you think the election is playing into the volatility we're watching on markets at the moment? And do you think, I guess, a Biden presidency, which is looking likely, although we never like to believe the polls too much, but if a Biden presidency was to take place, would this have an impact on things like tech?
Look, there's been a bit of controversy on that front already, because in the past, when we look at sort of Obama's sort of presidency and when Joe Biden was operating under it, Wall Street wasn't exactly favored amongst them, particularly from a tax break sort of area. So there is that concern that perhaps they bring those sort of policies back, or they may change leverage ratios again. There's a variety of different effects that we might end up seeing. I mean, Biden and Obama have been a little bit more blue collar favorable than what we see on the white collar side of things. So, but at the same time, I think the stability that we would see from having what you would consider to be a normal presidency, where you're not getting all your information from Twitter, would certainly be well received by the stock market. So I think that is one thing that we do have to keep in mind when it comes to it. And you're absolutely right on the exit polls. I mean, if we were to go based purely off exit polls, then we probably would have had Hillary Clinton, in 2016 as opposed to President Trump. But at this stage, it's too early to tell. I think really when it comes to the actual exit polls, the information that you get from them is so contradictory all the time. It's not real useful. You can say that Biden has the lead, but until we get to the actual day, we're never going to know. So that uncertainty is just going to hang around for an extended period of time, in my thoughts anyway.
Can you talk us through the Singapore Central Bank? It's not one we often speak about on AusBiz, but you're keeping, sort of one eye on it. Why is that?
Yeah, I'm not keeping a super close eye on it. I don't think that we're going to get a lot of action out of them. The Monetary Authority of Singapore has a little bit of a different rate system than what we see across other central banks. So they tend to monitor sort of 3 different currencies. And at the moment, you would have to have a look at the Singaporean situation and the economy as a whole and sort of say, okay, well, it's quite negative or depressing to look at. You've got, being a trade-reliant country, they have low trade. Their consumer spending is down, and you've got a variety, the US dollar down, which is sort of the counterproductive side to all of that. If you were to sort of take into mind that you've got all of those sort of factors going on, they've already cut once this year and made some changes around. I think it's probably inappropriate for them to actually modify the rate, which is why I'm not putting as much, keeping a closer eye on it or putting it under the microscope as much at the moment, purely because they only sort of do 2 reports a year. And this time round, I'm not expecting them to have much. And I'm not the only one. There are a number of other analysts out there that are sort of suggesting the same sort of thing. I think one of the surveys I saw was like that at 6 out of 20 was expecting a change, and the rest were like, nah, probably nothing's going to happen here. So, I am just keeping an eye on how that sort of develops. Obviously, the trade side is a problem, but also tourism. They do get a lot of income from tourism with flights sitting in the way that they are now. I'm not expecting much change there. Now, if they are to make changes, it signals that something more amiss is needed to be looked at very closely. If they don't change anything, it's going to signal to me that they're quite happy with the rate of recovery, considering their backdrop of economic data and problems that they've currently got.
Alistair, always a pleasure. Thanks for taking us through it.